Thanks everybody for joining us, and I could mention to each of you either on the phone or by email, we've had a lot of interest in the property that we're standing in at 1756 Clarkson. Since we sold it, we kind of figured it would be fun to have an event where we cater some food in, talk about the market, and then do a quick tour of the building. Greg is going to be handling the task of talking about the market, updating you on where the end of the year 2014 closed out at, and going over some trends just that we're seeing with vacancy and some other pertinent stuff. So this is definitely not a lecture. It'll be a quick presentation, and if anybody has questions on the slides, I'd give you permission to grill Greg and try to stump the speaker. So, but at any rate, we'll get going with the presentation, and then right afterwards, we'll go take a look at one of the one-bedroom apartments on this floor, as well as the community room, which we're in right now, and then next door is the workout facility. So we'll just take a quick tour of the property, and without further ado, here you go, Greg. Just do your clicker.
Terrific, thanks. Thanks guys for coming. Kyle and I have had similar conversations with most of you in the last month or so. Dennis, we first, but to just share market information. We thought it would be fun to do it in this building. This site had, I believe it was a 7-unit apartment building and a small early 1900s house on it when it was purchased in about 2005. By investors whose plan were to build 20 condo units. It was going to be a 4-story complex of condominium units. Fortunately, they pulled the plug on that idea right as things were turning in 2008, but they had already demoed the 2 structures. So this just sat here growing weeds for about 3.5 years when we marketed and sold the vacant land. Just over 15,000 square feet. It sold for just under $900,000, which $60 a foot right here. And boy, can we do that again? I see Dennis rolling his eyes saying, yeah, sign me up, I'll do it. The zoning, I think, had changed in the interim, allowing a 5-story structure to go, and they built 60 units. The really limiting factor on the units was how much parking you could get on the site. 2 levels of parking, one at grade and one below, seems to be the most economical mix. To add a second below grade parking just is so expensive that rarely do you see you get enough extra units to make sense. So when they figured 60 parking spaces, they knew it would be a 60-unit building, and then it was just a matter of working with the architect to lay out the space.
So they do that too. They do that going in. They want to go 1-to-1 ratio.
That was going to be the requirement of the city, and that has changed over the years. You talk to somebody 12, 15 years ago. If you talk to somebody 30 years ago, it was a parking space per bedroom unit, and it just became really difficult to make that work. And it's really the reason why since 1970. There had been very little infill construction. The Uptown neighborhood, Capitol Hill, Washington Park, neighborhoods, central Denver neighborhoods. But as the parking recently has relaxed to just 1 parking spot per unit, regardless of size, or if you were building 6-unit or 6-bedroom units, there may be something, footnoted that they wouldn't let you do that. But for studios, 1 or 2-bedroom units, it's simply 1 parking spot per unit. The construction of the property happened in 2013, pretty much all year. They finished their lease up of the 60 units fairly quickly. They got their temporary CO in December and started pre-leasing December of 2013. Started pre-leasing units, and their final CO and move-ins began, I believe, in late January. They were completely leased up. But for the last 3 units, they leased 57 by April. And in that, just a few months prior to that, Kyle and I had been approached by a local investor he had bought a 27-unit building that we had listed for sale over Achievement Park. And in conversations with him, he said, hey, if you have something slightly larger and or new construction, I'm interested. And quickly kind of put A and B together and said, yeah, why don't you come look at this building at 1756 Clarkson. It was not, Kyle had not actively marketed the property at that point. The developer had a number in mind, and so the deal was done at $15.2 million, or just over $250,000 per unit. But I'll talk about that kind of towards the end of the cycle, just to get kind of those basic metrics off the plate for where we're standing today. Things we wanted to do, really talk about Central Denver market for apartments, and then also talk about the construction and other activity that's happening. This is a slide that I've shared numerous times. Some of you have seen it. We've updated it for 2014 in terms of average sale prices for existing apartment buildings. There were 63 transactions that happened in Central Denver in 2014. Average price of $127 a unit. That does not include this building and just a couple of others of this size. There's one down at 6th and Logan that we're not including in these numbers. A smaller 11-unit building by East High School, also not included in the number. Throughout the decade, from 2000 to 2010, the market was fairly flat. I intentionally allowed these numbers to jumble and run together because that was the story of the decade. Prices didn't shift. It was 63-ish thousand a unit for 10 years. And it's really ramped up in the last couple of years. Primarily starting in 2010 with rent increases. As vacancy rates declined, landlords and owners started moving rents up. That gave investors reason to continue to begin to offer more money. And then in 12 and 13, that just ramped up. What's different this year, the reason for the dramatic increase from 107 to 127 has been you're starting to see better product on the market. So these were up and through 2012, it was kind of as is 1960s constructed apartment units, 20, 30 unit buildings. Really beginning this year, at the beginning of this year, we're seeing renovated property come back on the market. Buildings that were purchased in 2011 at 70,000 a unit, investors putting 20 to 25,000 a unit into them, and then turning around and selling them for 140, 150,000 a unit. Remarkably, in the 63 deals that happened this year, only 7 of them were below 100,000 a unit, which was way above in 2012, but only 10% of the deals were at that price point. Over that time period, and really want to talk about the last couple of years, what we've seen, cap rates have fallen dramatically, consistently below 6%, and it's because we're seeing interest rates consistently below 4% now. Whether Chase, who's the largest apartment lender in the Denver market, when we talked to them Friday, they're offering 5-year money at 3.69%. So as they're giving money away, it just allows cap rates to continue to fall. I mentioned the 63 transactions this year. Historically, again, that's kind of how it ran going back to 2001. You'd be about 60 transactions per year. Dipped significantly in 2009 and 2010 when financing was so hard to get, but also overall economy, investors were saying, is this going to be a double dip recession? Where are rents headed? All of that really, the lack of available funds and the lack of investor confidence, cut the market in half. But I'm thinking, Guy, as we were talking the other day about what's the opportunity to buy and to renovate apartment buildings pretty consistently. There's 50 to 60 deals per year that happen in the central Denver neighborhoods. Construction is on the forefront of most folks' minds, whether you're thinking of constructing yourself or Dan, think is with the portfolio of existing apartment buildings, what's this construction going to do to us? The Apartment Association, University of Denver, has not released its report yet. Kyle and I got a preview copy earlier this week to take a peek at, and as best we can put their numbers together, we know from third-party reports about 6,500 units were constructed. On this chart, what we're looking at by year, the blue bar is showing number of units constructed, and the red bar is how many new apartments were rented, the absorption. How many more, or in two cases, how many fewer apartments were actually leased metro-wide. The green line, we've put the vacancy rate in there. So what you see happening in the late 90s, where the amount built every year matched very closely with the demand for additional apartments, the vacancy rate stayed pretty flat. Around Y2K, when the dot-com bubble burst, and then after 9/11, when the national economy kind of ground to a halt, unfortunately, you had projects in record levels of construction that had already begun, that just had to be completed at a time when you were actually losing apartment renters. So you have a huge imbalance in the market, and the vacancy rate shot from about 4.5% to over 11% metro-wide. We quickly corrected that. Well, I shouldn't say quickly. I mean, it took 6+ years of dramatically reduced construction at a time when demand for apartments rebounded. But if we go to this, at the very end, post the 2008 financial meltdown, there has been on these blue bars very little construction by historical standards. It's happened in the Denver market up until 2013 when they started to rank. These are units delivered. And so again, in 2014, we're expecting the number to be 6,500 units delivered. Using that and the preview numbers Kyle and I got, we think absorption was a healthy almost 7,500 units. And what the Apartment Association reported was the metro vacancy declined from 5.2 to 4.7. So we're in good shape thus far. But what's coming this year, we expect will be construction off the charts. Numbers that we have, 19,000 units are currently under construction. The majority of those will be delivered in 2015. This particular building was a 12-month construction from groundbreaking to completion and lease up. And that 19,000 is ground broken, dirt's been moved. So we'll see somewhere probably between 10 to 13,000 of those units come online. Question is going to be, what's the demand going to be in 2015? Kyle and I put a piece in our newsletter that we just mailed out last week, asking even about low gas prices. There's folks, cheering at the pump. $2 gas, that's fantastic. But what's it going to do for jobs in Denver in particular? If that slows down some of the finance, accounting, engineering jobs downtown that are supporting the oil fields in Wyoming and North Dakota, that's gonna be something more to open to discussion to you all. We'll get to it. Vacancy rates, this is a chart, and we've been tracking this since about 2004, and in fact, we got data that predates that. Used to talk about this chart with investors with a central Denver focus, and between the blue line of the metro, Denver County, and the green line being central Denver, a lot of times said, look, central Denver historically outperforms the rest of the metro area. It has the lowest overall vacancy rates. That's largely still true, and we expect will continue to be true. But in the last 2 years, the story I've seen in this chart, vacancy across the metro moves just hand in hand, and it's really not separated. When vacancy goes up in central Denver, it's going up metro-wide. When it comes down metro-wide, it's coming down in central Denver. And it's the idea that apartments that are being constructed down in lower downtown, well, that won't really affect my apartments in Capitol Hill. Yeah, well, if they don't fill up, Capitol Hill doesn't fill up. Even back, and we're looking, you know, at kind of the 2001, 2002, 2003 timeframe, a lot of the vacancy perception was being driven by stuff down in Douglas County, in Parker Meadows areas, out west on 470, that were built that were having a hard time filling. Well, it pulled the vacancy rate up in central Denver the same quarter. And so, you know, going back to what's going to happen with these units, are they going to fill up or not? I think folks across the metro area need to together, you know, be watching that to see the impact that happens. One thing that was kind of unique this quarter, central Denver vacancy shot up from 2.5% to 6.9 was the number they reported, because they picked up a few brand new buildings that had just opened. They got surveyed, they hadn't filled yet. We're going to see some funny movement in the numbers, you know, probably throughout this year as those new units come online. The bigger thing to watch is going to be overall absorption and demand for units. Starting to talk already about this particular building, the stats on it. The sale price, when Kyle and I sold it, it made $15.2 million. His